I get this question a lot. Which is right for our company, debt or equity? Well, there are two really distinct types of financing, and you need to understand the benefits and the implications of each. Now, debt is an infusion of capital into your company, and the expectation is that there will be a periodic repayment in the form of principal plus interest. And the end result is the ROI for our investor, or the return on investment. And a good example of debt funding would be loans or bonds. There's some pluses and minuses. The biggest one for debt is positive is you don't have to give up ownership. The downside is this: you must have sufficient and reliable cash flows and collateral to back it. So it's really not a good option for most new companies. Okay, let's take a look at equity. On the other hand, equity is an infusion of capital in exchange for stock representing ownership in the company. Now, common examples for you would be a common stock, a preferred stock, and even warrants, which are the right to buy the stock at a future date at a given price. Now, the positives here are that you've got an infusion of cash with no debt service attached to it. The downside is this really is a high price or a high cost of financing. You may ask the question, well, why is that? Well, it's like this. Equity investors take on a high degree of risk, and their expectations are for a higher ROI. So if a capital seeker has questions trying to evaluate the benefits of going with equity or debt financing, we welcome their calls at Capital Match Point. And that's what we're here for, to help you get your company funded.